Too much refinancing of mortgages could push mortgage rates higher. So important to understand, on the other side of mortgages are investors that have an expected rate of return. When borrowers refinance quicker than expected, investors can end up getting their money back too soon and then need to look for somewhere else to invest. Because of these rapid payoffs, they may also want additional compensation for the refinancing risk to obtain the high yield they were receiving before. What that means is a wider spread between the yields on mortgage bonds and benchmark treasuries. The historical average since the Great Recession for the spread between the 10-year treasury and the 30-year mortgage is 1.7%. But over the last few years, it has actually been around 2 to 3%. After the announcement that the administration will instruct representatives to buy $200 billion in mortgage bonds, the spread narrowed to under 2%, but I'm curious to see if that lasts. The pace of refinancing has increased dramatically over the years, as nearly half of mortgages are refinanced with an interest rate of only 0.75% lower. 10 years ago, that rate was only about 33%. Non-bank mortgage firms like Rocket and UWM have really gained share over the last decade as banks have turned to different lending avenues like credit cards that are more profitable. Back in 2016, banks had some 60% of the mortgage market, but today bank shares has dropped to 25%, and UWM and Rocket have about as much share as all the banks combined. With the focus on mortgage lending, this has led to a better retention rate for non-bank mortgage firms, but it is still low at only 29%. This does compare, though, with a retention rate for banks that's around 15%. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.